Section 4.1 Introduction to Alpha, Limitations and Considerations. 4.1 Limitations of Alpha. While alpha is a widely used performance measure, it is important to be aware of its limitations. Here are some limitations of alpha as a performance measure. Historical nature. Alpha is based on historical data, which means it reflects past performance. It may not accurately predict future performance, as market conditions, investment strategies, and economic factors can change over time. Dependence on the benchmark. Alpha is calculated relative to a benchmark. The choice of benchmark can significantly impact the alpha calculation and interpretation. Different benchmarks can yield different alpha values, making it challenging to compare alpha across different strategies or managers. Sensitivity to risk assumptions. Alpha calculations are sensitive to risk assumptions, particularly in models such as the Capital Asset Pricing Model, CAPM. The accuracy of alpha calculations relies on the accuracy of risk models and assumptions used, which can introduce potential biases. Inability to differentiate luck from skill. Alpha measures do not always differentiate between skill and luck. Positive alpha can result from skillful investment decisions, but it can also be attributed to chance or random fluctuations. A short-term positive alpha may not necessarily indicate skill, and distinguishing between skill and luck requires a longer performance track record. Difficulty in isolating alpha. It can be challenging to isolate the specific contribution of alpha from other factors influencing returns, such as market exposure, style biases, or common risk factors. Failure to adequately account for these factors may lead to an overestimation or underestimation of alpha. Limited applicability in certain asset classes. Alpha analysis is more commonly used in equity markets where benchmarking is relatively straightforward. However, it may be less applicable in other asset classes such as fixed income, alternative investments, or illiquid assets, where benchmarks may be less well-defined or unavailable. Lack of universal benchmark. There is no universally accepted benchmark for every investment strategy or asset class. Choosing an appropriate benchmark that accurately represents the investment strategy's risk and return characteristics can be subjective and may impact the interpretation of alpha. Survivorship bias. Alpha calculations typically consider the performance of existing funds or strategies, neglecting those that have failed or been liquidated. This survivorship bias can result in an overestimation of alpha as underperforming strategies or managers are excluded from the analysis. Timing and horizon bias. The calculation of alpha is sensitive to the time period chosen for analysis. Different start and end dates can lead to varying alpha values. Additionally, alpha may vary depending on the investment horizon considered, making it necessary to assess performance over multiple time frames. Given these limitations, it is essential to use alpha as one component of a comprehensive performance analysis, considering other factors such as risk-adjusted metrics, consistency of performance, qualitative assessments, and a deep understanding of the investment strategy. It is important to approach alpha analysis with a critical mindset and consider it alongside other performance measures and qualitative factors when evaluating investment performance. Luck, market conditions, and survivorship bias can have a significant impact on alpha calculations. Here's a closer look at how these factors can influence the interpretation of alpha. Luck plays a role in investment performance, and positive alpha can sometimes be attributed to chance rather than skill. Random fluctuations in returns can result in short-term periods of positive alpha, but it does not necessarily indicate a manager's skill in consistently generating excess returns. To mitigate the influence of luck, it is important to evaluate performance over longer time horizons and consider the consistency of alpha generation. Market conditions can affect alpha calculations in multiple ways. During bull markets or periods of favorable market conditions, it may be relatively easier for active managers to generate positive alpha. Conversely, during bear markets or highly efficient markets, it becomes more challenging for active managers to outperform their benchmarks. The level of market volatility, correlations among securities, and overall market trends can impact the ability of active managers to generate alpha. Survivorship bias. survivorship bias arises when the performance analysis includes only surviving investment strategies or managers and excludes those that have failed or been liquidated. This bias can lead to an overestimation of alpha, as the poor performers are not included in the analysis. By excluding failed strategies, the reported alpha may be inflated, giving a distorted view of the manager's actual skill. It is important to consider survivorship bias and account for it in the analysis to obtain a more accurate assessment of alpha. To address the impact of luck, market conditions, and survivorship bias on alpha calculations, here are some considerations. Evaluate performance over multiple time periods. Assessing performance over different market cycles and longer time horizons can help reduce the influence of short-term luck and provide a more comprehensive view of a manager's ability to generate alpha. Compare against appropriate benchmarks. Choosing an appropriate benchmark that accurately reflects the investment strategy's risk and return characteristics is crucial. A well-selected benchmark can help account for market conditions and provide a more meaningful comparison for alpha calculations. Conduct sensitivity analysis. Assess the sensitivity of alpha calculations to changes in market conditions, risk models, and assumptions. Understanding the robustness of the alpha estimates can provide insights into the potential impact of different market scenarios. Consider risk-adjusted performance measures. Incorporate risk-adjusted performance measures, such as the Sharpe ratio or information ratio, alongside alpha calculations. Risk-adjusted measures provide a more comprehensive evaluation of performance, considering both the level of excess returns generated and the risk taken to achieve those returns. Account for survivorship bias. When analyzing performance data, it is important to account for survivorship bias by including the performance of both active strategies that are currently active and those that have ceased operations. This can help provide a more accurate assessment of the overall universe of investment strategies. By considering the influence of luck, market conditions, and survivorship bias, investors can gain a more nuanced understanding of alpha calculations and make more informed judgments about the skill and performance of investment managers.